As somebody who spends a lot of time on YouTube, TikTok, Instagram defending whole life insurance, I thought it would be really interesting to create a video talking about the good, the bad, the ugly of life insurance and whole life insurance in general, and kind of some of the things that are miscategorized in the whole life insurance space. Obviously, we know the people like Dave Ramsey and Susie Orman who love to hate on whole life insurance, but unfortunately, there are people on the other side of the spectrum, the people who are advocates of whole life insurance, that speak improperly about it as well. So in this video, my aim, my focus is to share the 5 things that I believe are, basically being said about whole life insurance that are not accurate, that are not true, that are misleading, miscategorizing what life insurance is all about. I went through, I thought about it, and I came up with the top 5 things that I hear the most that are not accurate on both sides of the pendulum. So if you haven't already, make sure you subscribe and hit the bell, that way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180. This video, we're gonna be talking about the 5 things that people say on YouTube, online, on social media, in regards to whole life insurance that are just not true. So let's do this. Let's just roll right into it. Now, before I get into it, I guess let me say this. I have videos that go way deeper into each one of these topics. The purpose of this video is to not do a deep dive, in-depth analysis of each concept, of each problem, of each miscategorization. The intent of this video is to really just expose you to the fact that these are some of the miscategorizations and the misrepresentations of whole life insurance on both sides of the spectrum. And then from there, you can dive deeper into it. Now, what I will do, I will put on the end screen a playlist that goes deeper into the power of whole life insurance. You can check that out. All of those videos are going to be in that playlist. So you can go there, you can check it out and go from there. All right. So the first thing that is said is that whole life insurance is a great investment alternative. There are so many people who are in the whole life insurance camp. Actually, here's the deal. There are a lot of people in the whole life insurance camp that will tell you that whole life insurance is a great investment alternative. And then you'll have other people in the Dave Ramsey camp and the Susie Orman camp that'll tell you that whole life insurance is a terrible investment. And so I think the conversation between those two is the problem in general, because here's the deal. Drum roll, whole life insurance is not an investment at all. Whole life insurance is a savings alternative. So this is the way I break it down. You have to categorize an asset in accordance with the risk assessment that goes along with that asset, right? So if you have to consider what's the difference between saving and investing, well, it's just a function of risk, right? With an investment, you can actually lose money to market risk. With savings, you got to have the money liquid and accessible and controllable and guaranteed, right? Savings cannot lose money. That is the intent of savings. Now, what I kind of show people is that whole life insurance is a great savings alternative. And I think if people would think about it through that lens and say, all right, if I got to save money, well, why do I need to save money? I either need to save money for an emergency fund, or I need to save money for an opportunity fund because I maybe want to invest in real estate as time goes on. Maybe I want to invest in a business, something of that nature. So where are you going to save that money? You can't save that money in assets that are going to be riddled with risk and variance and just the returns being all over the map. That you need that money to be there and to be liquid when you need it for the opportunity or for the emergency. And so whole life insurance, when designed properly, is going to provide you exactly what you need, from an emergency and opportunity fund perspective. But it is a savings alternative, not an investment. Anybody that tells you whole life insurance is an investment, run the other direction. And that leads me into number 2, which is whole life insurance premiums are not flexible. Here's the deal. Whole life insurance premiums are way more flexible than you probably think. And why is that important? Well, that's important because of what we were just talking about. We talk about saving money inside of an emergency fund, because I'm a big believer that everybody should have an emergency fund and that a whole life policy is the best place to keep your emergency fund. The people who are anti-emergency fund are the people that say, hey, if I lose my job, then I don't want to have this big outlay of cash that is required. And the reality is that you are not, if you design the policy properly, I should say, You will have the flexibility in the policy to be able to ride the wave of your unemployment, of the lack of income. And here's the deal. Let's just use an example. Let's say you were putting $10,000 a year into a policy because you were saving for your emergency fund and saving for future. Maybe you were just saving for the future, and it just so happens to be that that's where you're storing your emergency fund for now, just in case something happens, right? And so what happens with this $10,000 is that a portion of that $10,000 is completely flexible, and a portion is not completely flexible. The base is what you are obligated to pay every year. And in most situations, the paid up additions are what is flexible. Now, here's the challenge. There are different companies with different rules that have different levels of flexibility for the paid up additions. And so one of the things that I always say to people, because people ask me all the time, Chris, what's the best blend and design of a policy? Well, the best blend and design of a policy is one that fits your needs. And what I believe to be true is that the flexibility baked into these policies is one of the most important things. A lot of people like some of these big companies like Mass Mutual, Northwestern, like New York Life. A lot of these companies, and they're not bad companies, they're good companies. The challenge is a lot of times the flexibility with the paid up additions is not very good. If you take a year where you do have to take a back step and not fund the paid up additions because you lost your job and cash flow is low, then you are in a position where maybe you're not going to be able to fund the paid up additions moving forward again. And so I think it's really important to understand, what are your goals? What are your objectives? What are the risks that you have to consider? Because I'm a big believer you have to look at what's the upside, what's the downside, can I live with the downside? And obviously the downside, the worst case scenario is if you lose your job and you're not able to pay the premium, how are you going to manage that? And if you don't have a good answer for that, and you don't know what it looks like after things get good again, after things get better, you get another job and cash flow improves, if you don't know how you're going to be able to manage the policy from that point moving forward, well, then it's not the right policy for you. And you probably shouldn't be doing the strategy in general in the first place. So number two is that, that everybody's saying that whole life insurance is not flexible, but it is actually very flexible if you do it with the right company and you have the right policy design to fit your needs. So number three is the fact that Dave Ramsey always says people don't buy life insurance because it's a horrible investment, because the life insurance company keeps your cash value when you die. That's what they say. So one of the things I want to do for this one is I actually want to go to the board on this one. I need to illustrate this real quick and just kind of show an example. So here's the deal. So why does he say this? Because he would say if you have a premium, you have your premium, you have cash value, and then you have death benefit, okay? So let's just say your premium is $10,000. First of all, Dave Ramsey would say you have no cash value year one, so that it's not good to do. But let's just say that's not the case. Let's say you have $400,000 of death benefit, and let's say you actually do it with the right company, and you do the right blend, and you have, let's say you have $8,000 of cash value year one, okay? Now the nature of paid up additions is the fact that as you pay, let's just go down here and let's say you have $10,000 per year, so you've got $100,000 in total premium. That's a little messed up. On this, let's say this grows to $110,000 because your cash value is going to grow every single year. And in this situation, let's say the death benefit grew to $510,000. My guess is actually would be $520,000 or maybe even more. But let's just say that this is the case. So here's the deal. This is what Dave Ramsey says, is don't buy whole life insurance, because what he's used to is not using paid up additions. He's used to the basic blend. What Dave Ramsey would say is you have the cash value growing from 0 all the way to 110,000, let's just say, and this $400,000 death benefit just goes here and it's 400,000. Okay? So he's saying, well, in this situation, you're only getting this $400,000, not the 110,000. But here's the deal. This is still not as bad as Dave Ramsey says. But the problem is this 0, is typically 0 for a couple of years. You actually wouldn't be at 110,000 here. You'd actually probably be at like 70,000 or something like that. But the bottom line is, by year 10, the bottom line is, we're not doing this. This is the thing Dave Ramsey rants against. That's not what we're doing here. This is where policy design is really important. So when we go to year 10 here and we look at this, well, this is really what happens. So think about the alternative here. You could take your premium and instead of saving it in whole life insurance and creating more leverage with it, because don't forget, you get living benefits too, right? Which is really important for the medical directive control. If you get critically, chronically, or terminally ill, you have access to your death benefit while you're alive to pay for alternative treatments for things like cancer and other ailments that you might come across. So if this is the case, if your death benefit goes up by $110,000, but so does your cash, well, what are they doing? The life insurance company is going to keep this cash value, sure, but they just basically did that so they can pay it to you in the form of a tax-free death benefit. Because if you think about this, if we say, all right, we're not going to call this cash value, we're going to call it a savings account. First of all, if this is growing every year, there's a tax liability in a savings account every single year. With whole life insurance, it's going to grow tax-free, and you're going to have tax-free access. That's the first thing. And then secondly, we could just say, hey, what if we just did a $400,000 death benefit instead of this $510,000, and then they had $400,000 plus $110,000 in a savings account? That's an option if you want. You could buy term $400,000 and this would be tax-free. The $400,000 would be tax-free. The $110,000 though, you're going to get taxed on, right? Your heirs are going to get taxed on. So this is just the reason they take this 110 and they put it in here. The life insurance company holds on to the 110 and basically pays it through the death benefit. That's how they do that. And so there's a lot of different ways you could do it, but once again, it all comes down to policy design. Now, the fourth thing that we talk about that I hear all the time is that you never have to pay your loans back. Now, here's the deal. I understand the context of this. This is one of the reasons I'm really anti-online marketing when it comes to life insurance, because there's so much bad information. The clickbait nature of these comments are very appealing. I just had a meeting with a guy the other day. Actually, I should add number 6. I'm going to add a bonus in number 6 in a minute. It just hit me because I just had a conversation with a guy the other day that actually made me think about it. I'll add it in a minute. But here's the deal. You never have to pay your policy loans back is one of the most misrepresented things of a whole life insurance policy, because here's the deal. When you say that as an influencer, what you're doing is you're talking to people who are interested in utilizing the money right away. If you have a policy and that policy grows and it matures, and maybe you don't take a policy loan until you're 10 to 15 years into it, well, now you're probably going to be able to take a policy loan and you're never going to have to pay that policy loan back. This is how whole life insurance works really well through the utilization of withdrawals up to basis and then loans from there if you want, as a volatility buffer, or maybe even just use loans as a volatility buffer for your retirement income planning. It can be an amazing strategy. But the problem is a lot of people that get into this, they think they can just get a policy year one, borrow against it, never have to pay it back, maybe borrow against it in year 1, 2, 3, or 4, never have to pay it back. And the bottom line is, if you don't pay that loan back, eventually it's going to come back to bite you. If you take a loan early in the policy and you don't pay that loan back, it's going to come back to bite you. Nelson Nash always says you gotta treat yourself like a good banker, right? Like if you would pay the banker back, then pay the banker back, right? Like pay yourself as the banker back. Don't take a loan against your policy if you're not willing to treat it like a regular loan. And what I'd say is this is one of the reasons that I have, and it's one of the reasons I created my strategy called Cashflow hacking, is to get away from the conversation about utilizing your policy to buy depreciating assets like cars and stuff of that nature, and focus on cash flow producing assets that can feed your system and help you manage the policy loans all on their own, all while encompassing the flexibility and the unstructured kind of construct of the way that policy loans work. It's actually a really cool scenario when you combine the power of whole life insurance focused on leveraging and accelerating the performance of cash flow producing assets like cash flow producing real estate. Now, before I get into the bonus one, let's just talk about the fifth. I actually kind of spoiled the card a little bit when I talked about it here, when I talked about living benefits. One of the big reasons that I don't like the concept of buy term and invest the difference is because it thinks way too short term. And Dave Ramsey's conversation is saying, hey, you don't need insurance when you're older. If you just follow my plan, as Dave Ramsey, if you just follow my plan and you save enough money, you invest in enough mutual funds, and those mutual funds get you 12% a year, which is delusional, but let's just say that happens, and then you hit retirement, you could self-insure. You're not going to have any debt. You're not, you're going to be in good position, so you could self-insure. The problem is that loses sight of the fact that whole life insurance, when you don't have whole life insurance, you don't have all the living benefits that go along with whole life insurance. So the power of whole life insurance in retirement to be a volatility buffer, to make your other investments better, to have there for if you become terminally diagnosed with cancer or something of that nature, Alzheimer's, any kind of mental dementia, the ability to accelerate your death benefit on a tax-free basis to take advantage and control your medical directive and do the treatments that you want, not that the insurance companies tell you that you have to do, to me is an extremely powerful thing. All right, so that gets me to the 6th bonus topic here, and this is actually, it's crazy, and I don't know, this should be number 1. And this is going against the people that are for whole life insurance, right? So these are, and I think words matter. So this is the thing. The reason I don't like this is because it's confusing people, right? And I had this conversation with the other day. I drove up to North Scottsdale and I had a conversation with a really good guy who was looking to buy a policy, and he was really looking to do it because he's like, hey, if I put $50,000 in this policy and I get $1 million, I need to get this going now because I need some leverage. And I'm like, well, what do you mean? You need to take a policy loan? He's like, yeah. I'm like, all right, well, we need to make sure we design your policy so the cash value is available. He's like, well, but I've been reading online and watching videos that you borrow against your death benefit. And I'm like, yeah, well, the insurance company guarantees your loan against the death benefit, but you don't borrow against the death benefit. He's like, no, people are saying you borrow against the death benefit. And so he, and I know I get this conversation a lot, until I had this, this conversation to help straighten him out, thought that if he had $1 million, he could borrow a certain percentage of that $1 million. And that was his borrowing capacity, was the $1 million of insurance. Because people online are saying you borrow, the insurance company lets you borrow against the death benefit. No, you don't borrow against the death benefit. You borrow against your cash value, and the insurance company guarantees that loan against the death benefit. There's a wild difference there. You cannot leverage and borrow against the policy more than you've put in. That would just be too risky, and these insurance companies would be too susceptible to too much volatility, too much risk, and it would make no sense. So those are the 6 things that I see miscategorized about whole life insurance that I think everybody should understand more in depth. If you are looking to do more of an in-depth understanding about whole life insurance in general, I encourage you on the end screen here, click on this video and watch the whole life insurance, the power of whole life insurance playlist. I think it's like 60 videos long, but you can open the playlist, go in there, scan through the videos, see the ones that are most relevant for you and where you're at, what you're looking for. And if you ever want to connect with anybody, go down below, click on the schedule a clarity call with one of the people on my team. We'd be happy to help you out. It's a no pressure, no sales pitch conversation, just really looking to help you get clarity about how this stuff could look in your life. And if it makes sense, we'll work together. If not, no harm, no foul. Best of luck to you. So if you did find value in this, please like it, share it, get it out there to people. Subscribe, hit the bell. That way you're notified every time I launch a new video, because we got videos like this coming out all the time. Till next time, have a blessed, inspirational day. We'll talk soon. See you.